Good morning, Bitcoiners. Happy Thanksgiving for all of you watching in Canada, and welcome back to your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledin, and as with every Monday morning, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Monday, October 11th, Thanksgiving in Canada once again, and we have a very special episode packed with insights. In today's show, we're going to start by talking about the US Bitcoin ETF, which potentially could be approved in as little as 7 days. And we're going to talk about how that is impacting the Bitcoin futures markets and what insights we can draw from that. We're also going to be looking at the Treasury bond yields in the United States, which have been soaring as the US gets closer to full employment. And we're also going to get a big week of economic data out of the US. We're going to break down what we are going to be seeing and how it could impact your portfolios. Grab your coffees, everybody. It's going to be a great one. So starting as we usually do with Bitcoin, we see that Bitcoin closed its second consecutive week of gains, or double-digit gains, actually, last week, finishing higher by 13.43% at $54,714. And we see that last week it also had double-digit gains at 11.65%. So again, back-to-back double digits. And from a technical standpoint, it's also very positive to see that it did so on stronger volume than the previous week. So that again is quite good to see. And nonetheless, as we've been highlighting here, we've been flagging or following these four lines that basically were acting as support and or resistance for Bitcoin. And it seems to essentially have slid through the upper bound resistances like butter, the ones that we were basically tracking before. And those may turn into support later on. So we'll continue to track these levels. But again, pretty positive from a technical side to look at that move and that volume. So if we zoom out on the daily, we see that Bitcoin actually had a pretty big rally on Wednesday, and that's this candle right here. And as you can see, it was done on quite a strong volume. And again, while these large and sudden moves are typically driven, or most often driven by short squeezes, data from CryptoQuant last week suggests that the move was actually driven by a $1.6 billion market buy order. And this is the data that we are referring to just now. And as you can see, all exchanges taker buy volume essentially it represents that this was a very, very large transaction that was placed essentially on a market buy basis. Needless to say, whoever is placing a $1.6 billion market order is not a small fish. So, rumors abound that this could be a large hedge fund manager or a large hedge fund or asset manager taking a position in Bitcoin ahead of a possible ETF announcement coming up. Now, looking further under the hood at last week's move, we also see some insightful trends. For one, and for this, I'm going to pop this chart right here. For one, we are seeing the implied premiums on the 3-month Bitcoin futures contract at the Chicago Mercantile Exchange, the CME, trade very closely, the premiums, to those to essentially the 3-month contract, the 3-month future contract on Binance, on the exchange Binance. These are two very different exchanges, and these two premiums don't usually trade in tandem. This is usually not the norm. To make this picture a bit more clear, I'm going to pass over to a screen where I have actually highlighted some of these times when Bitcoin or the premium on the CME and the premium on the Binance contracts have actually coincided. And as you can see, the CME contracts, which is the yellow line, when that premium trades close to those of Binance, the brown line, it typically coincides with a rally in the spot price of Bitcoin, which is the black line that you see on the screen. This time, as we can see, as of late, they have actually started trending together, and it has been no different. We have also seen a rally up in prices. We expect, given what we're going to cover just now around the Bitcoin ETFs, that the CME premiums could remain elevated until we hear from a decision on the SEC, and that's going to happen throughout this month. Remember, the ProShares Bitcoin ETF could potentially be approved in just 7 days. So next Monday, exactly next Monday. Bloomberg Intelligence is pinning the odds of an approval at 75%. That is quite significant, and the Bloomberg ETF analysts track this very, very closely. The Bitcoin ETF could be the biggest change in market infrastructure for Bitcoin infrastructure since the launch of the CME Bitcoin futures. The ETF will create strong demand for CME futures contracts, which will certainly create investment opportunities versus spot Bitcoin and also arbitrage opportunities with other ETFs like the ones that we have in Canada. The other fascinating takeaway from these elevated Bitcoin futures premiums versus the spot price is that it will create a structural issue for a futures-based Bitcoin ETF. Remember, most Bitcoin futures contracts on the CME, whether it's the front month contract, the 3-month contract, or the 6-month contract, those always or usually tend to trade at a spot or a premium, essentially, to spot Bitcoin prices. Every time the fund has to buy further contracts out as the one it holds expire, a couple of things are interesting. Whenever you hold a contract, a futures contract, into maturity, it settles at the spot price. So every time you're having to continuously roll those contracts into further out ones, you're paying that premium. So you have this continuous bleed versus the spot price of Bitcoin. So again, it's not essentially the most efficient mechanism, but it seems to be the one that the SEC is most comfortable with. And moving onwards, and some other clues on the ETF excitement around Bitcoin could also help explain why Bitcoin has been vastly outperforming DeFi and Ethereum as of late. And we're going to check that comparison now. Here we are going to add Ethereum and the DeFi perpetual contract into this chart. And as you can see, Bitcoin is quite outperforming both Ethereum and the DeFi index, even if you date back as of the start of September, and even if you come back and make it as of the start of October, again, you still see it. So the difference is quite clear. Something's up, and investors are expressing their views. Seemingly, some of this could be attributed to the ETF excitement. So to close out this section, we wanted to highlight that in under 18 months, U.S. Bank, and this is the one that we're going to highlight. We're going to put right here. U.S. Bank went from closing client accounts who transacted with Bitcoin to this, the headline you have on your screen right now, which is the fact that they launched a Bitcoin custody service as institutions cater to crypto demand. So a note to U.S. Bank that we can learn from, or to other banks, is that life comes at you quite fast. Moving over to our analysis of the S&P 500, we see that most major U.S. equity indexes finished the week mostly lower. We see here that essentially we see here that most U.S. equity indexes finished the week mostly higher. We see that the S&P 500 finished the week up 62 base points at 4,390 points. Looking at the Dow Jones, we see that it finished the week up 1.22% at 34,746 points. And looking at the NASDAQ, we see that it also finished the week higher, just 20 basis points at 14,820 points. As we discussed last week, the market focus was on the US Senate, where a compromise was reached to extend the debt ceiling until December. This prevented a potential government shutdown. And this is the headline that came out last week from the BBC, which again describes how the vote averted a potential crisis in the US government. Now, the debt ceiling compromise helped make markets finish higher. However, jobs and inflation data continue to make the case for the Fed to stay the course on its tapering plans. This dampened the forecast and made Treasury yields soar last week. We're just going to check in those quickly. We're going to dive more in depth into those in gold. But again, look at last week, the move on the 10-year yield up 9.41%. 30-year bond yield went up by 6%. Again, we'll break those down in more detail in our gold section. But again, the debt ceiling will be definitely something that is great to prevent the government shutdown. But the data that is coming out continues to corner the Fed into the into its tapering, essentially, which will continue to put pressure on equity markets. So just taking a look at US unemployment for a second, the data for September that we got last week was mixed. The US economy added only 190,000 new jobs, the fewest number of new jobs in a month so far this year. Now, in spite of that, so many people stopped looking for work in the month of September that the unemployment rate in the United States actually dropped from 5.2% to 4.8%. The US labor participation rate, however, is currently at 61.6%, which is down almost 2% from its pre-pandemic peak. So a lot of people are just not going back to work. And here is some of that data that we were just talking about. Again, this is just a good infographic for MarketWatch that covers, net new jobs to 194,000, unemployment rate drops to 4.8%. The average hourly pay actually took a bump higher at 4.6%. So these are some pretty interesting takeaways, and we'll cover how these could, what the second order effects that these could have. So last week we discussed how societal changes brought upon by the pandemic may have caused a structural shift in the US labor market. This was, particularly this hit the restaurant and the service industries quite hard, while uplifting technology, finance, and crypto, leading many people to actually retool and have to switch careers. This, something very similar was said last week by the former Treasury Secretary of the US, Lawrence Summers. Basically, he said that at 4.8% unemployment, the US could already be below its new natural rate of unemployment. And as a refresher, the US Fed currently defines the natural Fed of unemployment or sets it at 4.4%. So they're not too far off, but some shifts may mean that this 4.4 is not necessarily accurate anymore. And Summers says that, again, we might quite be below the natural unemployment rate. Why is this important? It's important because when an economy is at or below its natural rate of unemployment, keeping interest rates below the rate of inflation creates inflationary pressures as companies have to essentially overpay for talent and make up for it by driving the prices of their stuff higher. We are already seeing signs of this, as we just mentioned. Hourly wages or average wages rose by 4.6% in September from a year ago. Checking in on China and turning the page for a second in the US, signs of contagion around their real estate companies continue to emerge. Last week, we saw, and this is the headline that refers to this, we saw another large Chinese property developer, Fantasia, fail to make a bond payment. For context, Fantasia is about 20 times smaller than Evergrande in terms of revenue, but at $3.5 billion of revenue per year, it's not a small company by any means. Counterintuitively, if we check in on the China index, the China ETF, we see that it actually finished last week higher by 3.44%. This is quite counterintuitive, but this could just be a short covering or relief rally. So again, we may continue to see this index under pressure in the weeks ahead. As a parting note for this section, although it may not come as a surprise to longtime readers, the IMF, or watchers of the video, the IMF signaled last week that supply input shortages could, quote, keep inflation elevated for a prolonged time. This is this headline that you have on your screen. However, it thinks that these inflationary pressures could subside or should subside by 2022. Remember the word transitory? Again, this is just Google Trends to show the decline in the interest or the decline in essentially the presence of this word in the narrative. The word has been gradually dropped from the narrative when describing the current inflation situation. Its search interest is marking lower highs since January and is projected to go back down to essentially just 9% of its relative peak in quite soon, in fact, in the coming days. This is how things become normalized. Moving over to our analysis of gold, we see that US Treasury yields soared last week on the back of improving unemployment rate, as we've just covered, and positive data. Anyway, let's just go through this. The yield on the 10-year note was higher by 9.41%, and it's now sitting at 1.6%. The yield on the 30-year note rose by 6.03%, and it's currently sitting at 1.23%. So again, as we've covered here, checking in on gold, gold finished the week lower by 23 base points at 1,746. So again, this is not a surprise. This is something that we've been covering here. And as the Fed continues to march towards tapering, this means that the bias or the pressure on bond rates is to the upside. Gold has an inverse relationship with the real return of Treasury bonds. So as the yields of these Treasury bonds rise and inflation stays relatively the same or still, this puts tremendous pressure on gold, and we're seeing this play out essentially in real time. Looking in at the US dollar index, which is also quite important for commodities, we see that it continues to consolidate. So this was the move last week, essentially flat after quite a big move higher. And it does look like it wants to continue moving higher. Now, while this is typically a headwind for commodities, we are seeing oil prices, like again, we're just going to open up, US oil, just look at it, it's just gone vertical. And something similar is happening with natural gas prices, which is leading many to write headlines like the one we just saw over the weekend from the Wall Street Journal. This headline reads, "Soaring energy prices raise concern about US inflation and the economy." Again, oil and natural gas are the inputs for a lot of things. So when the prices of those drive higher, it typically tends to spill over the course of a few months into the rest of the supply chain. So again, the huge soar or run up in oil prices is in part due to supply concerns as countries replenish their reserves for the winter. This is particularly the case for natural gas. With the Fed marching steady towards its tapering and the trend for higher bond yields will continue, this will likely continue to put pressure on gold until something changes on this front. Moving over to the DeFi index, we see that the DeFi index finished last week lower by 7.57%. And we see that Ethereum finished the week essentially flat, up 13 base points at $3,422. Checking in on the price action of DeFi tokens, again, just looking at the drop in the DeFi index, we may be seeing a rotation out of DeFi tokens and into Bitcoin, again, as evidenced by the relative outperformance of Bitcoin versus the DeFi index and Ethereum, which we just highlighted in our Bitcoin section. This could not just be due to the ETF, but also due to the follow-on effects of that bug, that compound experience. Again, we are putting on the headline on your screen. 2 weeks ago, we reported again, as the headline broke from CNBC, that a bug from compound had caused a $90 million payout error. Last week, that number grew to $162 million and could potentially still be growing. This is not an insignificant mistake or error, and it could lead to investors reconsidering their risk exposure to these types of protocols. Checking in on the comp token itself, we see that it lost 7.06% last week, and it was trading at $375. Literally, just actually, it was 394. It was trading at $354 since September 27th. So it's come down quite steady over the last few weeks. This DeFi to Bitcoin flow could continue given the excitement around the backdrop of a potential Bitcoin ETF approval in the weeks ahead. Moving over to our Bitcoin mining difficulty commentator, we see that last Monday's difficulty adjustment saw difficulty move higher by 4.06% to 19.89 terahashes, while we're still 25%-ish away from our all-time highs of 25 terahash. We have been consistently moving higher since July 17th. It's been essentially vertical and just upward adjustments since that day. Checking in on the mempool, we see that things have remained relatively quiet, still pretty much smooth sailing all across, with next block confirmations still in the single VByte per Satoshi range. So it's a good time to transact on chain. Now, as always, we leave you with what's ahead for the week. As we continue our seemingly inevitable march towards higher interest rates, equity markets could remain under pressure as Treasury yields continue to rise. Now, knowing this, politicians will do their best to keep markets appeased and will try to support the Fed in a smooth landing as it lets interest rates rise. After extending the debt ceiling last week, we could see Biden's $1.4 trillion infrastructure bill get passed very soon. There were articles last week basically stating that Democrats are aiming to have the bill passed by the end of this month. This should provide a catalyst for the markets and help neutralize some of the tapering fears. Now, the increased spending from this infrastructure bill may not have the same inflationary effect as previous stimulus bills. The spending is not going directly into people's pockets, which is typically known as demand-side stimulus, we just saw. Instead, the money is going into the budgets of corporations so that they can hire and invest, which is commonly known as supply-side stimulus. Now, even though it's not the same type of stimulus, it will still provide a boost to inflation, particularly in an already tight labor market, as we described above. There's just going to be a bidding war for talent. Now, as always, we leave you with a summary of the upcoming economic data and earnings reports that we can expect for the week ahead. It's quiet on the earnings front, but it is quite active on the economic data side. So Tuesday, 10 a.m., we get job openings in the US. The expectation here is for 10.9 million open jobs. On Wednesday at 8:30 a.m., we get the consumer price index reading for the month of September and the core CPI reading for the month of September. The expectation is for a 0.3% increase month over month on the CPI. That would mean a 3.6% inflation rate and a 0.1% core or increase for core CPI. Again, that would mean a 1.2 annualized inflation rate. So it'll be interesting to see how that data comes out. At 2 p.m. on Wednesday, this is a very big one, is the FOMC meeting minutes. We may get more details around the tapering, and the risk here is that Fed officials, if Fed officials share or show an aggressive acceleration of their tapering plans, this may precipitate a move down in or on equity markets. Lastly, on Thursday, we get at 8:30 a.m. Eastern a producer price index reading out of the United States. This one will be very interesting as the expectation here is for a 0.7% month over month increase. This represents an 8.4% annualized rate or annualized increase. This is really high. It's the highest I've seen or we've seen in all of the recent inflation readings or producer or consumer price readings. Remember, the producer price index, these moves are often seen as predecessors to consumer price index moves. We are already way above those targets on the Fed side or the Fed's inflation targets on the inflation side. So we don't really need any additional upward pressure on inflation. That would just rush the Fed into further action more quickly. So we've covered a lot. It's going to be a jam-packed week. If you like the show, if you have any questions, any feedback for our future shows, we welcome you to drop it in the comments side. If you enjoyed the show, if you learned something, we welcome you to like our episode and subscribe to our channel. And if you don't yet have a Ledn account, we welcome you to check out ledn.io when you can start earning up to 9% on your USDC and up to 6.1% on your first 2 Bitcoin. We also have excellent rates on your Bitcoin-backed loans if you have Bitcoin and need dollars but don't want to sell your stack. Thank you, everybody. Have a wonderful week and see you next time.